Hello guys, welcome back to my YouTube channel. My name is Matirizi. On this video, we're talking about the importance of risk management. Risk management is a way we assess the amount of exposure, negative exposure we have to uncertainties. Risk management is an approach that we use to estimate the amount of negative exposure we have to uncertainties. In forex trading, we know it's a business of uncertainties. You can do your analysis in the market and expect the market to buy, and everything is right and perfect, and you end up having a failed trade or a loss, meaning that the market went in the other direction, selling. Now, that does not mean that you are at fault or you are wrong with your analysis. It might just mean that the market is not just in the condition to follow that your analysis for that day, for that setup. Now, the question is this: how do we now manage these uncertainties? There is a way you can take a trade and you know that you can make a loss. It's not you that is the owner of the market. How do we now manage this amount of uncertainties that we can have in the market? We know that multiple times you can take analysis and majority of the time it might go against you. It might not go in your direction, not because you are wrong, but because maybe you didn't want to just say what you that day. And the question is this: since you know that there's a tendency of the market going against you in your opposite direction, then how do you now manage the risk you are putting on the table? For example, you have a $1,000 account and you're about to risk $50 per trade on every trade you take, and you know that if you lose about 20 trades, you're going to blow that whole account. The question is this: if you take those 20 losses back to back, we know that you are going to definitely blow the account by the 20th trade you will lose. Now, the concept of risk management is that yes, you are going to lose in the market, and yes, you are also going to win in the market. You might not win as much as the times you will lose, and you might not lose as much as the times you will win. That depends on the strategy you are using and the strategy's accuracy. Some strategies have accuracy of about 60%, 50%, some 40, some 70, some depends on the strategy's strength. The accuracy does not really matter if you don't have a good risk to reward ratio. The risk to reward ratio you are going to use for your strategy is dependent on the strategy's strength. For example, if you have a strategy that is as strong as 70% accuracy, what you are trying to say is that if you are going to win on that strategy, out of 10 trades, you'll be winning 7 and you'll be losing 3. A win is when a trade you entered moves from your entry point and hits your TP and closes automatically by the broker. Now, a loss is when a trade moves from your entry point against you to your stop loss. Many beginner traders used to get lost in this angle of risk management, where they don't know where to take their profit from a setup. If they get an analysis now that is going their way, they get afraid and confused on where to close out the position. Sometimes they close out with fear and they close out with a low risk to reward ratio, and they feel okay because they have made money. Now, in the long run, that doesn't help your account. Why? Because it doesn't help your account grow and stand the test of time. What do I mean by test of time? I mean times you start having your losing streak or your losses back to back. Now, the time you are making profit and you are taking, let's say, half of your half profit, you're not taking your full TP, and the time you're taking losses, you are taking full losses. If you do the mathematics, you're going to end up seeing that those amount of losses you are taking, which is full losses. For example, if you are planning to risk 1% on a trade and you end up losing that whole 1%, then you are now in a winning trade, and that winning trade is going in your direction, and you now close it below 1-to-1 risk to reward, or you close it below 1-to-2 risk to reward. Definitely you made money, but in the long run, how many of those trades can you win, and how many of those trades can you lose? Many beginner traders fall into this trap where they go into signal group chats and they end up losing money in the group and start blaming the mentor or blaming who is sending the signal for sending bad signals. No, the person is not really sending bad signals. Maybe you are not just taking the signals properly. If you are not exercising those risk to reward approach towards your own signals you are taking, definitely you will be in the negative end, because most of the time the person might call signals that are lower in accuracy, meaning they are below like 50%, 30%, but because he has a high risk to reward ratio, it remains profitable in the long run. But because of you are taking a signal and you don't understand this point of view from the person's perspective, you might go and be closing your own trade earlier. Then once you close your own trade earlier, once the person gets into his losing streak and starts sending those losing signals, you will be going down in your own equity more than him. Why? Because on his own end, he's taking his trades and allowing it to get to his TP and closes at his full TP. So that when he's losing, he doesn't lose so much that he starts getting back to his initial capital that he brought to the market. You see the difference between in risk management, we utilize what we call risk to reward ratio. Risk to reward ratio means a particular mathematical ratio that tells you how much money you are going to make if you risk a particular amount of money in the market. For example, if you are using a 1-to-1 risk to reward ratio, it means that if you are risking $10, you're going to make $10 on that risk to reward ratio. Now, if your risk to reward ratio is about 1 to 3 or 1 to 4, 1 to 4 for example, it means when you risk $10, you'll be making $40 on that risk to reward ratio plan of yours. Now, for example, let us take it to the point where you are making a 1 to 2 risk to reward ratio and you are risking $100 on a trade. You'll be getting $200 on that trade if you hit your TP. Now, what is the benefit of this risk to reward ratio? This is now what brings us to another concept called strategy accuracy. Strategy accuracy is the amount of times that strategy will hit your TP compared to the amount of times it will hit your stop loss. For example, you take your entry at a point, then you put your stop loss below the candle or below the zone, then you are targeting a 1-to-1 risk to reward ratio. The amount of times that trade is going to hit your TP in a consecutive number of trades, that is the amount of strategy strength that strategy has. For example, if you are taking a trade sample of about 20 trades and you have a 50% win rate, it means that 10 out of 20 times your trade is going to go to your TP, while the remaining 10 out of that 20 times it will go to your stop loss. What this means is that if you are going to inculcate this 1-to-1 risk to reward to your strategy strength, which is 50% accuracy, it means this is how much money you'll be making at the end of the day. You'll be making 50%, which is 10 trades, times the amount of money you are risking. Let's say you are risking $1,000 per trade and you are targeting a 1-to-1 risk to reward ratio and you have a 50% accuracy in your strategy. What is going to happen is this: in 20 trades, you'll make 10, and those 10 will multiply by that 1,000 that you are making on every win you make, which is $10,000. Then the amount of money you'll be losing per that 10 trades that you will lose is also 1,000 times 10, which is another $10,000. At the end of the day, you're making what? Nothing from that whole 20 period of trading samples. Now, how do you now give yourself an edge in the market? You do this by setting a risk to reward that is going to offset this balance of negativity and positivity in the market, your profit and loss, your wins and your losses. For example, if you are going to be winning 50% of the time and losing 50% of the time too, the point is, if you have a risk to reward ratio higher than 1-to-1, you definitely have profit at the end of the day. For example, if you are risking $1,000 and you're trying to make $2,000 on your TP, which is 1-to-2 risk to reward ratio, and you are using that same 50% accuracy of your strategy, it means that for 10 trades, you'll be making $2,000 if you are risking $1,000 per trade. Then for 10 losses, you'll be losing $10,000. At the end of the day, you will be net up about $10,000 in profit. Are you seeing how the edge manifests when you have a positive risk to reward ratio with a good strategy accuracy? Now, if you have a risk to reward ratio of about 1-to-4, you can be having a very low accuracy of about 40% or 30%, and you will still be profitable. This 30% of the time that you win, let's say you are winning 3 trades out of 10, that's 30% of 10 trades. That 3 trades that you are winning, each of them you are risking $1,000 to make $4,000 on each of them. It means that for the 4 trades, you'll be making about $12,000. Then the trades that you will be losing, which is 7 trades, 7 trades times the $1,000 you'll be risking on each trade, $7,000. Now, $12,000 profit minus $7,000 that you lost. you'll be having a net profit about $5,000. Now you see how with a higher risk to reward ratio and a low accuracy, you will still come out profitable in the forex market. Now, this is the concept of risk to reward and the benefit of risk to reward in foreign exchange market. If you have waited in the video to this point, I should give you a tip or two concerning how you can select a good risk to reward ratio for yourself. Now, your risk to reward ratio depends on some factors. Example, your personality. If you are this impatient type of trader or person, you should understand that having a high risk to reward ratio might not fit your style. You might not be able to catch things like 1 to 5 risk to reward, 1 to 6, 1 to 4. So you can stick to ratios like 1 to 2, 1 to 1.5, 1 to 2.5. I recommend 1 to 2 and 1 to 2.5 if you are not that patient to wait for 1 to 4, 1 to 5. Now, also, if your strategy is not as high in accuracy as 50% or 60%, you should also stick to reward ratios that are higher than 1 to 2 or 1 to 3. For example, if you have a strategy that's netting around 30% accuracy or 35 or 40, anything below 1 to 3 risk to reward ratio means you are going to be net negative at the end of the day when you trade for a long time. So you should consider this when you're selecting a risk to reward ratio for your system, and make sure that you don't go with one that's going to make you negative in the long run. If you like this type of content, please hit the like button so you can get recommended to other viewers like you. Then also don't forget to subscribe. Then turn on your post notification on this channel so you don't get to miss out on videos like this in the future time. Thank you for watching this video. Peace out.